What's going on, guys? Just wanted to come on here and just talk to you guys a little bit about some psychology stuff that really helped me transform my trading, which ended up taking me from losing money every single month to making upwards of $30,000 in 1 month of trading. And what I kind of wanted to talk about is just kind of keeping consistency once you find what I like to call your pocket. Now, this could be something that you use with weightlifting or trading or just, once you're in kind of like your flow and you're like in the flow state of things and you just stick with that and you just don't step outside of it. Because once you step outside of that, that's when you're going to start seeing, different kind of results rather than if you just stick to one thing and do it all the time. So the reason why it is so important for you to stay consistent with your model and just one model when you're starting out trading or you're trying to achieve consistent profitability is because you are building confidence with that model, right? So as you are building confidence, taking only trades within one model, you're seeing, let's say over time, now you have 100 trades, 500 trades, 1,000 trades. And I'm talking about back testing, forward testing, and everything. When you get all these repetitions, right, you have more confidence because you know what the result is going to be like. Rather than if you were doing back testing all these different trades, all these different models, you're trading all these models, you don't have the confidence in taking these setups and you start getting emotional about your trades because you don't know if they're going to play out. You don't have the confidence, you don't have the repetitions, you don't have the experience trading that model. So that's why it's so important when you're starting off to just stick to one model, build the confidence and consistency there, and don't stray away from it if it's working, like if it ain't broke, don't fix it. So stick with that, and that will get you so much further along in your trading journey than you think it's going to. And over time, you're just going to build so much confidence. And when you're confident in your trading, it is so easy to just compound wins. And just over time, it is just a continuous effect of winning and winning. And then you just scale from there and you're making a ton of money. Yes, it's very important to learn how the markets move and all these PD arrays and whatnot, and just understanding what the market is telling you. But the best way to achieve profitability consistently is to stay super consistent and keep your models simple, right? You could go learn all the ICT concepts in the world. You could learn order flow. You could learn everything you want, but that doesn't mean you're going to be profitable if you can't execute accordingly. That's why it's important to have a very simple and clear cut like entry model and risk to reward and game plan, because it's just easy to execute on rather than if you're needing so much stuff for your entry and it just makes it a whole lot more of a headache. So you don't need all these concepts. It's good to know them so you can kind of understand price action better, but it's not necessary to like build a model around this. And another thing I wanted to talk about is when you build confidence in a model, and you have more confidence in how the markets are moving, you are mastering your emotions as well. You don't want to put yourself in situations or circumstances where you are going to potentially be, emotional and irrational. You don't even want to put yourself in these situations. So when I say this, it is very important to just keep your emotions in check, because you could say don't trade with emotions, trade like a robot, but let's be honest, we're humans, we have emotions, and it's not possible to just get rid of them. So you have to understand how you react to your emotions, and some people are different. Like for example, when I take a losing trade or continuously taking losing trades, I tend to try and revenge trade. So what do? I lock myself out, and that's just a way that helps me, not let my emotions get the best of me. For other people, they may not be over traders or revenge traders, but they might just get scared and just not trade at all. So that's why in that circumstance, it's important to kind of have a simple entry model and just understand how the markets move. A really big thing, psychological, that helped me is just understanding when market conditions are choppy, that the odds are not in your favor. So let's say you have a model and your win rate's about anywhere between 70 to 75%, and you're trading on high probability days. when we get choppy days, your model is not going to work out as much. So that automatically brings your win rate down. If you're trading only on high probability days, I guarantee you that your model would be playing out at a way higher win rate than if you traded the choppy days as well, because price does not deliver as efficiently, as smoothly, and it doesn't deliver how you're going to want it to. And at that time, if you're in a trade and it's just chopping around, it's going to build up emotions, and then you might start making some irrational decisions. So in my opinion, it's best to understand when conditions are going to be choppy or just not high probability, and either de-risk a lot or not trade at all. And the way I like to think about it is I like to look at the red folder news for a couple weeks. You have to understand what major news events are in that month and in each week. So for example, the week before CPI, we actually had pretty good price action. And then we had CPI on Wednesday, I believe, or Thursday. So I was waiting for price action to clean up after these days because I wasn't expecting much. And everyone was like, oh my gosh, why is price action so choppy? It's because the market is waiting on a huge news driver. Although, the markets are programmed to move algorithmically, the markets are still waiting for that news release in order to, start moving the market again. So you have to understand, okay, we have CPI next week. We are more than likely going to stay in a range. And if we expand, it's not going to be anything crazy. Now this week as well, we have FOMC, and there is talks of us having our first rate cut of the year. And there's a lot of buildup going into it. So what can you expect? You can expect price action to not be breaking out or be super clean because the market is waiting for this high impact news driver in order to move the markets. Now, this is just something I like to look at to try and gauge conditions. Also, hopping on the 1 hour before the market opens, marking out any clear draws. If there's no fair value gaps and there's no high and lows that look, pretty smooth, the odds of us chopping and combining that with the news conditions and what's going on with the overnight sessions, if you combine all three of those things, you'll be able to identify conditions so much easier. And then another thing also that helped me psychologically and with my trading as well is just stay off the 1 minute chart when you don't need to be on it, right? The 1 minute chart shouldn't be used to, frame your entire trade idea off of. You have to be framing your trade ideas off the higher time frame. So what I mean by this is stay on the 5 minute chart, 15-minute chart. Once you have an overall, I don't want to say bias because I don't like to use the word daily bias, but once you have an overall draw, an idea of where you think the market is going to go, then you start scaling down and framing an entry. But you don't want to get your trade idea off the 1 minute time frame. And I think this is what a lot of people get confused about. And the same thing is I see people going to 30-second time frame. If you can't trade consistently profitable, don't even go on the 30-second time frame. The 30-second time frame is only good for getting a more perfect entry than you would on a 1 minute or a 2 minute. But your trade idea is still coming from the 5/15/ even higher time frame, and that's the only reason you should be taking trades is when the higher time frame is aligning with your trade, because otherwise your win rate's not going to be that high. It's not. You're trading against the trend. You're trading against what the higher time frame wants to do. So when the higher time frame and lower time frame align, those are the trades you want to be taking. Then you could take them with size confidently, and you don't have to take as many trades because you are going to be taking way high probability trades compared to trading them in choppy conditions or trading against the current draw and everything like this. So I hope this helped you guys out a little bit. Just wanted to drop some sauce for you guys. I'm going to make another video soon. So if you have any ideas or what you want me to record, just drop a comment below. Let me know. And I do give live commentary every single day in my Discord for free. So if you are not currently in there, I'll put the link in the description of this video. Be sure to check that out. I'll catch you guys later.